Holy smokes, everyone. Did I make a huge mistake? Did I miss the bottom? Did I miss the bottom when the Nasdaq hit an intraday low of 20% from its peak? And did I miss the biggest buying opportunity of the decade? This is exactly what we're going to get into in today's video, so let's not waste any time. Let's get straight into it. Okay, so first things first, what's been happening in the markets lately is the markets hit a low of Thursday last week where the S&P 500 fell around 15% before we saw the huge intraday reversal, and we also saw the Nasdaq fall peak to trough of 20% before again that 7% intraday reversal. We've seen Bitcoin rise all the way from 34,000 to 45,000. So what exactly is going on with this rally? What caused it, and will it continue? Well, everyone, first things first, what you have to know is during a downturn, during bear markets, you're going to have sucker rallies, you're going to have bull traps, you're going to have rallies and huge amounts of volatility before we enter a prolonged bear market. So this kind of volatility we're seeing right now is completely normal. But the question I've been asking myself over the past 2 to 3 days is, okay, what are the markets telling me? Did I miss the bottom? Should I start going back in now? Because again, I do want to buy back into the markets, but I want to buy back in for the right price and at the right time. So for the past 3 days, I've been going crazy, analyzing the markets, analyzing what the Federal Reserve is saying, the macroeconomic picture, and I've been trying to figure out if I did miss the bottom and if I should go in now. Well, after a lot of deep thought, after a lot of analyzing, I do not think we hit the bottom last week. And let me get into the reasons why. First things first, I've been watching what's going on with oil right now. Brent crude oil hit $115 per barrel, and people, you have to understand how much of an impact oil has on the markets. And many analysts are predicting that Brent crude oil could hit $140 per barrel. And do you know what happened the last time a Brent crude hit an all-time high? That's right, that was in 2008. You know why Brent crude oil has such a big effect on the markets? Well, think of it like this. If you're a consumer, if all of a sudden your fuel costs, your petrol, your gas, wherever you are, however you want to call it, in which country you're in Australia we call it petrol, in the US they call it gas. If all of a sudden you're having to spend double what you spent on gas or petrol compared to a year or two ago, well, that means you're not going to have as much money to spend out there on discretionary consumer items. Also, what this means for businesses, a lot of their costs go up. Then this means it's going to hurt their profit margins, so they're going to have to lift costs. And higher oil prices is pretty much just like a tax on the economy. It weakens growth and it weakens consumer spending. So that's the first headwind I see coming for the economy and coming for the markets that I don't think they're prepared for yet. Many people think this is just a short-term spike in oil prices and they'll go back down. That very well may be the case, but if it doesn't, and if we hit a new all-time high, well, I think this is going to be disaster for the economy and the markets aren't prepared for this. Now, the second headwind for the markets right now, what we've all been talking about for a while now, is the Federal Reserve. And Jerome Powell came out and spoke today on lawmakers on exactly what he's going to do with lifting interest rates during a time of huge uncertainty with what's going on with Russia and Ukraine during war times, and what he thinks on inflation. And he also spoke on what's going on with oil prices. So let's turn to Jerome Powell for a couple of minutes to see what he's got to say. Then I'll break it down exactly what this means for us investors.
And so the question now really is how the invasion of Ukraine, the ongoing war, the response from nations around the world, including sanctions, may have changed that expectation. It's too soon to say for sure, but for now, I would say that we will proceed carefully along the lines of that plan. The thing is, the economic effects of these events are highly uncertain. So far, we've seen energy prices move up further, and those increases will move through the economy and push up headline inflation, and also they're going to weigh on spending. We're seeing effects on other commodities and perhaps from declining risk sentiment and weaker growth abroad. The thing is, we can't know how large or persistent those effects will be. That simply depends on events to come. So this is where that leaves me. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. We're also going to write down our new summary of economic projection, individual forecasts, which will show each participant's views of the path forward in the economy and with rates. I also expect that at this meeting, we'll make good progress toward an agreement on a plan to shrink the balance sheet. We will not finalize that plan at this meeting. We'll do that when we think the time is right at a coming meeting. The bottom line is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy. We use our tools to support financial stability and macroeconomic stability. We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. So that's how I would think about it.
Very specific. Now, you mentioned 25 basis points. From all the analysis about what the Fed will do over the course of the next year, is 25 basis points the floor, the ceiling? Is it the speed limit? Is that the max you think the Fed could take on? How do you think of that?
So here's how I think about that. We have an expectation, those of us on the committee have an expectation that inflation will peak and begin to come down this year. And to the extent inflation comes in higher or is more persistently high than that, then we would be prepared to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings.
Okay, so first things first, there's some huge insights on what Jerome Powell is thinking during this summary of this meeting with lawmakers. Like I said, he agrees that higher oil prices will weaken demand and weaken growth. But what's kind of funny, he's playing the transitory game again, saying that these higher oil prices are only temporary and they'll go back down. He also confirmed now that there will be an interest rate hike in the Federal Reserve meeting of 0.25%. Now, some people were debating whether there'll be a half a percentage point rate hike, but now he confirms it would only be 0.25%. And he also said they're going to discuss tapering their balance sheet in March, but they're not going to come to a final conclusion of when exactly it'll be. He also spoke about the conflict with Ukraine and Russia, and he says this is really, a game changer, and they're going to have to proceed with caution and be very careful. And I think this is why we saw the markets rally today, because they're trying to figure out what's the Fed going to do. Are they still going to go ahead? Are they going to be more careful? Are they going to be more dovish? Well, the Federal Reserve says we're still going to go ahead with our rate hikes planned, but we are going to be very careful. But then he was asked, well, okay, what are you going to do if inflation, doesn't get better? What if it gets worse? Are you still only going to do 0.25% rate hikes, or may you get more aggressive? And so the Federal Reserve admitted, look, we're willing, to adjust. If inflation doesn't get better, we will move more aggressive with half a percentage point rate hikes. So again, going back to my analysis and me thinking if now is a good time to get back into the markets, if I miss a dip, if I think we're going back up to all-time highs, my short answer is no. And let me tell you the reason why. I already told you how oil will affect the markets, but what I think nobody's prepared for is the markets have already priced in the first 4 Federal Reserve rate hikes. So we're not going to see the markets move that much during the first 4 rate hikes. But what the markets aren't prepared for, and what I expect to come, just like when, everyone was talking about deflation in 2020 and 2021 and saying that inflation is transitory, people, inflation is going to get worse. These higher oil prices are going to make inflation skyrocket. And the Federal Reserve is going to have to do much more than 4 to 6 rate hikes to get inflation under control. We're going to see headline CPI of 8%. Do you think interest rates of 2 to 3% will stop 8% inflation? No way. And if you have 8% inflation and a federal funds rate of 3%, guess what? In real terms, that's still a negative rate. So I think higher oil prices, a weakening economy, weaker consumer confidence, skyrocketing debt, Federal Reserve lifting interest rates is a perfect combination to lead us into recession, just like many people have been predicting, and I've been predicting in late 2022. Now, I have been saying a lot of this sell-off recently has been from the uncertainty of the conflict with Russia and Ukraine. And I did say during my previous videos, once the actual conflict starts, the markets will recover because they try to price in when it happens. They sell more on the uncertainty. They try to price this in. But once the conflict starts, once they can assess the situation, what kind of effects it will have on the markets, then that's when they start to recover. But if this conflict escalates and it turns into something much more, which I don't really want to even get into because it'll just be too catastrophic to imagine, well, we would see the kind of stock market crash like what we're seeing in Russia right now, with the banks plummeting 95%. But again, with that kind of scenario, the last thing you'll be thinking about is your investment portfolios. Now, quickly, what happened with Bitcoin with its recent surge to $44,000 when it went from around $36,000 is what happened is Russians and Ukrainians, they went in and started buying up cryptocurrency, and it wasn't just them that brought it up that made the price go up. What happened is, and what we always see in crypto is squeezes. We see liquidations. When we see a huge drop of 15 to 20%, It's most likely because a lot of long positions got liquidated, and when we see a huge spike in price, it's because of a short squeeze. And what we saw on the day that Bitcoin went all the way to $44,000 is we saw $250 million worth of short positions liquidated. And so this has caused a short-term spike in Bitcoin's price. Now I'll do another video on Bitcoin and how, I'm really starting to see some promising signs from Bitcoin and cryptocurrency with what's going on with Russia and Ukraine, with the freedom and liberty it's giving to people, with the people that are getting debanked, they're using cryptocurrencies. But again, that's a topic for another video. So again, it was just a short squeeze that caused this short-term trigger in price for Bitcoin, and we'll have to see if this price of 44,000 can be supported. So everyone, to put it simply, I don't think this sell-off is over. And like I said, there's going to be a lot of volatility. It is not going to be a straight, decline to the bottom. We're going to see a lot of green days, a lot of red days. For me, I'm very patient. I think there's going to be more buying opportunities ahead, and I don't mind if I have to wait a couple months longer. Now, for all my loyal viewers and subscribers, if you want to get up to 5 free stocks with Moomoo, worth all the way up to $3,500, for when you deposit $100, I'll put a link in the description. Thanks for watching. I'll see you in the next video.